In today's episode, I'm talking about the US India partnership that could help both countries speed ahead in the green energy race. And then we'll talk about India's new investing obsession. Hello and welcome to the Daily Brief. On this show, we cut through the noise and simplify the biggest stories and trends that are shaping the markets. I'm your host, Kashish Kapoor. Today's Monday, 7th October, and I have two big stories for you. First up, India and the US have just teamed up. The two countries signed a deal to make sure that they have steady supply of critical minerals like lithium and cobalt, stuff that's crucial for making EV batteries and clean energy technology. This agreement isn't just about digging up new minerals. They want to build a stronger system to explore, process, and even recycle them, keeping both countries ahead in the green energy race. Before I get into the why and how, let me take some time to explain what are critical minerals. Critical minerals are key ingredients in many of the technologies that we rely on today, from smartphones and electric vehicles to renewable energy systems and even advanced defense equipments. These minerals like lithium, cobalt, neodymium, dysprosium, and graphite have unique properties that make them important for the production of all the cool things we need in today's world. For example, rare earth elements are crucial for making strong magnets used in wind turbines and electric motors, while lithium and cobalt are needed to make rechargeable batteries. So these minerals are pretty important. But there's a problem here. The supply of these minerals is vulnerable because their production is concentrated in just few countries. This makes the global supply chains prone to disruption. As demand for green technologies and advanced electronics grow, making sure that there is a stable supply of these critical minerals is very important. And guess what? One of the biggest challenges in this supply chain is China's overwhelming control over both mining and refining. This creates a global dependency that many countries, including US and India, are eager to reduce. To give you an idea of how irritating and big this problem is, China controls almost 70% of global rare earth production, around 58% of world's lithium refining, and 80% of world's cobalt refining. While countries like Australia are the world's largest producer of lithium, around 50%, and Democratic Republic of Congo produces around 70% of world's cobalt, these raw materials are often shipped to China only for processing. The chokehold that China has on the production and processing of these rare earth minerals makes it an important part of the green technology value chain. This includes everything from electric vehicles to wind turbines. It's fair to say that there's no green transition happening without China, considering how central it is. And this isn't just about production, it's about control too. China has the ability to disrupt supply chains by restricting exports of critical minerals. A recent example is antimony, a mineral used in semiconductors and defense technologies. In the past, China has limited exports of antimony, which affected US semiconductor industry. Another example is China's decision in 2023 to restrict exports of germanium and gallium. These two minerals are also used in semiconductors, solar panels, and defense systems. This move raised concerns globally as these minerals are critical to advanced technologies and disrupted production across defense and electronics. Now imagine the worst case scenario of a war between US and China. The disruptions to the global economy will be unimaginable. And the Russia-Ukraine war-related energy disruptions will seem like a walk in the park. Now coming back to the story, why does the India-US deal matter? Both countries want to diversify their supply chains and reduce their dependence on China. It's simple. For India, this deal helps secure the materials needed to support its growing EV market and clean energy goals. For the US, it ensures a more stable supply of these essential minerals without relying so heavily on China. India, despite its ambition in clean energy and EV sectors, lacks domestic production of key minerals like lithium and cobalt. This deal with the US helps India gain access to these critical minerals it needs to accelerate its transition towards green energy. India's future potential lies in recycling technologies and urban mining, which can extract valuable minerals from used electronics and batteries, contributing to a circular economy. On the other hand, the US is seeking to reduce its dependence on China's refining capabilities, as geopolitical risks of relying on a single player are growing. A diversified supply chain is essential for national security, clean energy, and emerging technologies, making partnerships with countries like India essential for their long term stability. This deal marks a significant step towards reducing global dependency on China for critical minerals. While this partnership between India and US is still in its early stages, it signals a shift towards diversification and collaboration as countries around the world prepare for a greener and more sustainable future. As demand for these minerals continue to grow, deals like this are crucial for ensuring a stable and secure supply chain. Though the India US deal is not the final answer, it's critical first step in a broader strategy to challenge China's dominance in this field and pave the way for a cleaner energy production. Now on to the next story. Not too long ago, Indian households were known for their conservative investment choices. Safe deposits, gold, or maybe a little bit of property. But as the world changes, so have we. In just a few years, household participation in India's stock market has grown tremendously. And today, we are here to explore how big that shift really is. To start with, recent data from Motilal Oswal's research, which uses the RBI's estimates, shows something surprising. Household participation in the stock market has grown a lot, especially since the pandemic. In fact, Indian households now directly own 21.5% of India's listed stock market as of June 2024. This percentage has stayed stable between 21 to 22% over the past few years, but it's much higher than 16 to 17% seen back in 2011 to 2016. If we compare this with other major countries, the 21% to 22% figure is actually quite impressive. You see, in most major economies, except for the US, household ownership of listed stocks is usually between 11 to 18%. The US is an outlier here though, with nearly 40% owned by the households. But India's 21% still shows more involvement than expected. Now let's look at the bigger picture beyond just direct ownership of the stocks. Households also invest indirectly through mutual funds, and this area too has been growing very quickly. The total size of the Indian mutual fund industry has reached about 61 lakh crores as of June 2024. What's more, households, including both retail investors and HNIs, hold about 63% of these assets, which is up from 55% in 2019 and 50% a decade ago. This means households are not only investing directly, but also using mutual funds to invest in the market. When we combine both, direct stock holdings and indirect investments through mutual funds, the total exposure of Indian households to the financial markets was around 134 lakh crore as of the first quarter of FY25. To put that in context, this is 44% of India's GDP. While this might seem small compared to countries like US, where household exposure is over 160% of GDP, it's actually quite similar to 30 to 55% range seen in most advanced economies. This growing exposure isn't just a number. It shows a change in how Indian households are managing their finances. Let me give you a number for that. The share of equity and mutual funds in total household financial assets has grown significantly from 17% in 2019 to 28% in 2024. While it's behind countries like the US, where it's 43%, it's significant progress for India and suggests that Indian households are becoming much more comfortable with investing in stocks. So the next time you hear someone say that Indian households are conservative investors, remember that things are changing. The rise in stock market participation and the growth in mutual fund investments show that Indian households are actually becoming more and more financial savvy and willing to take calculated risks for better returns. And that's it for the stories. Let us move on to some interesting tidbits for the day. First, Blackstone is raising $10 billion Asia-focused private equity fund. In this fund, they want to prioritize India over China due to challenges in their investment landscape. This brings huge amount of capital into India's growing market, boosting investment across sectors. Number two, Temasek is in talks to acquire 10 to 15% stake in Haldiram, valuing the company at $11 billion. This potential investment could set the stage for Haldiram's IPO in future, reflecting rising interest in India's consumer market. Number three, OpenAI enhanced its liquidity to $10 billion after securing a $4 billion credit line. This is after the $6.6 billion funding we talked about in one of our previous episodes. Despite projected losses, investor confidence remains high due to anticipated revenue growth in the AI segment. And finally, BSE will retain Sensex weekly derivatives while discontinuing the BankX due to SEBI's new rule of limiting weekly expiries. We talked about this in depth in our last Friday episode. You can tune into that to know why exactly SEBI did this. And that's it for today. This is Kashish Kapoor signing off. See you in the next episode.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.